On today's video, we'll be looking at the most powerful reversal pattern in the forex industry. We all know that there are many, which is head and shoulder and so on, but we pick the most powerful ones that always occur on the market and always comes to the advantage of the forex trader, which is ascending channel, which is descending channel, which is rising west channel, and also falling channel. If you want to see how to trade these patterns, make sure that you stay tuned on this video. We are going to make sure that you are able to identify those channels and be able to trade them at the end of this video. We are going to look at ascending channel, which is the first reversal pattern that we are going to look at. We are going to look at 4 of them, but then let's start at ascending channel. So on ascending channel, this is how ascending channel looks like. The market comes from the downside. The market comes from the downside like this and start to correlate, but going on the upper side on the same direction. It shows that the market starts to lose its momentum to the upper side, and then you will see something like this. It is going to shoot where it comes from, because this correlation shows that consolidation, mean to say, shows that the market is no longer have that powerful movement to go to the upper side, meaning that the sellers are trying to come inside of the market. So now the buyers are starting to lose its momentum. So you are going to have your own trend line like this to show that this is a consolidation to the upper side, so you can know when to enter the trade. So your entry point, you always have 2 entry points, but I always advise people to go for the risk one. But in order to go to the risk one, you need to be very good. The risk one is right over here. This is where you are going to enter your trades. If you enter your trades right here, the market might go to 90% rule. This is called 90% rule, but I will go deeper into details when time goes on. So your target is going to be right over here. So if you enter here at the breakout of the channel, you are going to have a less risk to reward compared to when you come over here as a risk entry. Let me show you. Let's say you enter your trade right over here. Then your stop loss will be up over here. Then your TP is going to be 90% rule. You're going to have a solid 1:8 risk ratio. But let's say that you enter at the breakout, right? Let's say you enter at the breakout here. This is where you're going to end. Look at your risk to reward. Your risk to reward is going to be 1:1, which is, it is okay if you know that your strategy is about 50% win rate, but we need to maximize our profit. So I want us to go straight to the market and show you how to trade this. Remember, the bigger the ascending channel, the more you have the risk to reward. The smaller it is, the more you're going to have less risk to reward. Let's go to the actual market to show you. Now, this is the market that we see. We can see that the market is going to the upper side. So we need the reversal where the market is going to turn down. Remember, to trade this ascending channel, it needs to be supported by the support and resistance, meaning that if the market goes up, you need to check if the resistance is there upwards when it starts to consolidate. Right over here, what we see our own reversal, mean to say our own ascending channel like this. This is our own reversal channel, and also we're going to put it right over here. As you can see, the market has been coming to the upper side. So now that we see this channel whereby the market starts to consolidate, this shows that the sellers are trying by all means to beat the buyers, and the buyers are showing the exhaustion of the market. Like I said, the risk entry, you always go for the risk entry, and you always have to have 3 touches. So on this channel, we have 3 touches. This is our first touch right over here. Sorry, This is our first touch right over here. This is our second touch over here. We didn't count this because it didn't actually give us a proper signal that is going down. So it consolidated straight at our trend line. That's why we don't consider it. And then we have another one right over here. 3 touches, meaning that the third touch, you're going to enter your trades. But most of the time, the market always comes to our third touch, not go to make our fourth touch. That's why you will have your own resistance right over here to market that the market might come back again to give us a proper movement to the downside. So you can always enter right here or wait for the market to come here to give you a signal that you are going to sell this market, meaning that your entry is going to be right over here and then your stop loss is going to be above over here. You don't put stop loss based on pips. You put stop loss based on the trades that you are taking, whether that if let's say maybe you are saying this trade if surpass this trend line or something, then I will be wrong. That's how you put your stop loss, not based on pips. Imagine if I take this trade, right, and I say my stop loss needs to be about 20 pips or something, I'm going to lose this trade. But if I say if this market surpass this point, then I'm going to win. So your take profit, like I always say, that it goes to the 90% rule. This is what we are having. This is going to be your take profit. And as you can see, the market really went to our take profit 90% rule, but it took time, right? You need to be patient because I'm a swing trader. I'm not a scalp trader or a day trader. I prefer swing trading so that I can place my trades and then enjoy my life at the time, not always be on the market. So this is how you spot your reversal pattern, which is ascending channel. And also, if someone maybe ask you what is a ascending channel, ascending channel is the typical characteristics of an ascending channel involve 3 touches, which is at these 3 touches, right? 3 touches on both the bottom and the top, paired with corrective nature throughout, indicating a potential reversal of a price, right? As you can see below right over here, we also have our own touches, first touch, second touch, and also third touch. And but there's something that I want you guys to see. If you can check right over here, we still have our own our own ascending channel. So you can be able to enter right over here. And like I always said, that your take profit needs to be on 90% rule, which is right over here. Let me show you that why I always say that people must not enter their trades right over here, must always go for the risk entry, right? Here we have 1:8 risk to reward. Let's say you enter at the breakout, right? When you enter the breakout, look what you have. You have 1:2. You have a low probability trade. That's why I always advise people, please make sure that you master your sniper entries to get more profitable trades. I'm going to show you right over here. Let's say you enter here at the third touch, right? You enter the third touch, and also your trades, your take profits need to be 90% rule. You have 1:3 risk to reward. But if you enter at the breakout right over here, it doesn't make sense. 0.56 risk to reward. It doesn't even make a 1:1 risk to reward. So this is how to identify your ascending channel. Now let's look at descending channel. This is how descending channel look like. We have the market coming from the upper side going to the downside, and also going to consolidate to the downside to prepare us taking our buys to the upper side. So this is how it looks like. The market comes down and start to consolidate to the downside like this, and then shoot to the upper side, right? You are going to have your trend lines like always to confirm that it was consolidating for a moment before it shoot to the upper side. So if you go to our first pattern, which is ascending channel, I explain into deeper details. So what's happening here is the opposite of what's happening on ascending channel. So someone is still going to ask you, what is a descending channel? A descending channel is very similar and involves 3 touches like ascending channel on both the bottom and the top pair with corrective nature throughout, indicating a potential reversal of price in a play. Looking for buyers as price reaches a potential reversal area. This is descending channel. Let's go to the actual market to show you exactly how to spot it and also trade it. Now, this is the market that we have. We can see that the market has been going to the downside. Now that it consolidates right over here, it shows that it is tired, it is exhausting by going to the downside, meaning that the sellers are trying to push the market to the downside, but they are not winning. And also buyers come with force to force the market to go to the upper side. That's why you see this correction right over here. So you are going to mark that correction. We are going to have, remember, we have to have 3 touches. So this is our first, our second, and also our third touch. Let me mark them like this. This is our first, this is our second, this is our third touch, right? And also we are going to do the very same thing from the upside, right? We are going to look for something like this. So as you can see, this is going to be our first touch right over here. This is going to be our second touch. This is going to be our third touch, which is normally not really a third touch, but it is. I will explain later. So as you can see right over here, the market was consolidating, right? Consolidating to the downside to prepare ourselves to take our buys. Like I said, always go for risk entry. If you can see right over here, this is our risk entry where you are supposed to take your trade. Let's say you took your trade and also you are going to go for 90% rule. You can see the market really went to 90% rule. Like I said, I'm a swing trader, so you have to be patient when trading this. But you can still do it on a smaller time frame, but it is more valid on a bigger time frame, right? You are going to have 1:9 risk to reward. But if you go for the breakout, the safe entry, your risk to reward is going to be small. You are going to have 1:1, which is not, for other people it's reasonable, but for me it's not reasonable. I need to have a high risk to reward. Maybe I need to have less 1:3 upwards. Anything less than 1:3, I don't trade it. Remember, when you see something like this, yes, the market has been going down and also it represented as descending channel. That doesn't mean that the market, it is always going to push to the upper side. It might still go to the downside. The reason why I'm saying that, you don't really look for something like this and then enter your trades goes to the, there is certain things that you need to consider before you can confirm that this is really going to it. One of them is to check whether you have your support somewhere, somehow, that supports that the market is going to, sorry, I threw this thing, yeah, right over here. This is a support area where the market, when it comes, it always return. So when the market is approaching this level right over here, it needs to consolidate. That's when you confirm that this trade needs to, this trade, in fact, it is the proper one to take. And also there are things like candlesticks to watch before you take this kind of trade. This is the end of the video, but then I know that I said I'm going to go through 4 things and I only gave you 2. So for us to have a part 2, please make sure that you hit the subscribe button and also give me at least 10 likes for this video so I can drop part 2.